Yeah.
Alrighty, welcome in. It's another week here, and we're about to break down the markets with you guys. This is the week before the non-eventful week, so I expect there to be quite a fair bit of, pricing in of data, so on and so forth, just to give you a little bit of a understanding of what's about to happen here. So you obviously have, uh, you know, a big calendar that's going to be massively, uh, you know, I want to say packed for next week. But this week, you'll have CPI, you'll have PPI, and that's the main event for this week. Okay. This information will all lead into next week, where you have the FOMC the key rate decision. Okay. And the FOMC key rate decision is the one that will likely be priced in sometime on Friday. But I would say once CPI comes out, people will already start pricing in FOMC the week after. Because depending on how inflation is, then people start drawing their own conclusions on what's about to happen. Okay. Now, having a look at just the data from this week, let's just kind of start at where we ended last week. And this is one of the more important things that I wanted to show you guys is that we had towards the end of the week some put protection that was being bought. Okay, there was a big spike in activity on the OEX put to call ratio, and actually that kind of put a lot of interesting things into motion. Another part of this that's a bit interesting is we saw a bunch of Meta deep in the money 328 calls being bought late on Friday. You can see majority of these were pretty much 580 calls bought for March 28th. And there's about, I would say, 10 million roughly of this strike and expiry. Now, does this information say that, oh, you should go all in on Meta calls? No, it doesn't. So before you start thinking of that, just take that out of your head right away, because I know how some of y'all think. But what you should be waiting to understand and see is if this open interest changes hold through this week and the week after. Okay. And then also you have the anti-VIX indicator, which last week came off the buy signal, which was the sell signal for the VIX, and now is heading into the sell signal, which will then be the buy signal for the VIX sometime this week. So if if this starts to head up here, then expect the VIX volatility to start creeping up again sometime this week. And if we look at just where Goldman Weekly prime book positioning was, this was the 10th straight week of short sales, and broad-based equity, right? ETFs were sold. Single stocks were sold for the third straight week at the fastest pace since November 24, driven by short sales, and 8 out of the 11 sectors were sold, led in notional terms mainly by, you can see, financials, energy, healthcare, infotech, while staples, real estate, and comm services were the only net bought. So you can see that in the background, technology, right, and financials, which are the two biggest sectors, were net sold, and then the smaller defensive sectors were net bought. Okay. Well, actually, out of this, it's only really staples that's a defensive sector, right? And then U.S. financials were sold for the second straight week at the fastest record. So, excuse me. Whew. Yeah. Okay. So that's that. Have a look at the update on your little graphic graph, right? So you have financials, energy, healthcare, all of them seeing 5-day, 20-day outflows, which will eventually at some point rebound. Also, you have infotech, right? You have utilities, consumer discretionary, materials with the 20-day inflow, real estate with the 20-day inflow. So those are your sectors as per flow. we're going to ignore this, not really that important. And then we're going to look at the prime book report. So you have hedge funds, which net sold Chinese equities for the fourth week, driven by both short and long sales. And you can see that here, onshore and offshore equities were net sold on the week, led by ADRs and H shares. This is post DeepSeek, when China was by far notionally net bought. So you can see that some of this is going outflow from hedge fund market, while China is rallying, right? So this is how sometimes I catch the moves before they happen, because I can pretty much see where the prime book activity is, right, in terms of where these big players are moving their money. Of course, you have to follow through with flow, you have to follow through with price action, you have to follow through with risk management before you can even, think about anything else. But that's the general consensus. Tactical sentiment, we came back to here last week and then back down, right? And I presume that we'll be here all the way till post FOMC. That's the way things have been. And this is one of the things that I pinned, which you guys should go in and read. It's the first thing pinned. Go have a read on it. It's basically the prime book report, but it's just a summary of everything. Okay, I think you should read this on your own. Now, part of this is also this report that I'm following. I don't know how many of you remember this, but we were talking about, the list of phase 3 AI beneficial companies that were going to rally before, this big dip happened. And now it looks like the playbook's moving into phase 4, okay? Phase 3 was mainly let me just show you guys here, right? Your phase 1 was your semiconductors and chipsets. Your phase 2 was infrastructure, right? Phase 3 was enabled revenues, and phase 4 is productivity, okay? So we've moved, the market has shifted from here to here to here, and now it looks like phase 4 is the next phase in which we're looking at the next run to happen, okay? So surveys suggest US corporations are still in the early stages of AI adoption and widespread productivity enhancements. Our basket of stocks with the largest potential EPS boosts via adoption and labor productivity gains, phase 4 is unchanged, but we reset the basket constitutes to equal weight. So they have given a list of phase 4 adopters that are identified by tangible productivity benefits since the last earnings. Specific use cases including customer support, coding, engineering, inventory, supply chain management, stocks that overlap between early adopters and our long-term phase 4 basket are Amazon, CTSH, IQV, KMX, and Walmart. Okay. Now there is a whole report on this. I can post it for you guys, but the entire basket is posted here as well. And as usual with this, it doesn't mean that if something's here, it's a no-brainer or that you should go bet your house on it. You should look at these and align them with your risk to return opportunistic, agenda and see if it's a fit. Obviously, see if the technicals make sense. See if you're willing to take risk in any of these. Then only should you be actually trading any of this. It doesn't mean that they put a list out means you just go crazy on them, right? But there are some names on here that are looking pretty nice, okay? So this was the AI phase 3 stocks, and then the AI phase 4 are right here. These are the screen of early phase 4 adopters. And I can post this on this Discord somewhere. Okay, now, from a macro perspective, the Fed is going to have its work cut out for itself next week because of all of the, very messy tariff situations, inflation adjustments in terms of forecasting, which this week is not going to tell us anything, right? Remember, this week you're getting a report on February inflation. The trade wars or the tariffs have just kicked in or will kick in April. So inflation data this month actually doesn't really do much for allowing us to know whether tariffs are going to hit the market, how is it affecting the market, et cetera, et cetera. This is the reason why I told you guys, my view is that June or July is where, we start to see some of this, the residual effects of the tariffs hit. And that's when you enter stagflation, and that's when the market throws a fit. But then this happened, right? The market's priced in all of that, and it's potentially pricing in more of that in the future, right? So we might enter a temporary correction of 10% or more in this next couple of months. And so while that may seem bleak and like, oh man, things are, not going to rebound or whatever, understand that for long-term investors, this is the dip you've been waiting for, right? If you're somebody who has been waiting for the market to come down for a long time, this is that dip. And so when the market's pricing all the bad news in, and then when June, July hits and the stagflation news is revealed, the market would be like, aha, we knew it, and they'll start buying, right? So it'll be the reverse of what I said now, because I didn't expect the market to price everything in at once. I thought that, we'd have a gradual sell-off, like something where it's more controlled demolition, but unfortunately, the market has other views, right? It's pricing in everything at once. But the only reprieve that we have is the fact that the Fed will now, probably have a more dovish character. Hopefully, we'll see this next coming week, right? So from a technical standpoint, we've seen a, pullback of about, let's see here, 6.7%, right? 6.7% from the highs. And that's very normal. 5% is like the minimum, right? And now, having said that, there's been a 6% pullback, we need to also take into account that where would a 10% pullback be? Well, on the SPX, the 10% pullback would be at around 5,500, okay? Now, I'm not saying that this will happen. What I am saying is I'm looking at the data that last week on Discord, if you will look at it, on the golden flow, right? There were some interesting, curious bets being placed, okay? Let me show you. So first of all, there was someone who placed a couple of bets on the 7th of March, that's your 6th of March, 554 puts, 1.74 million for March 21st, okay? That's pretty far below us, right? 544. That's here, very, way down in this region here. Okay, here, we're talking about here now. Somebody's aiming for this here, okay? Then, also, I started to see more. 543 puts, 1.74. 543 puts, 2.89 million. And then you had IWM puts come in, and then obviously some IWM calls as well. This was more like a hedge bet, right? Then you have 540 puts for April come in, 2 million. And you had 541 puts, not almost a million. And then 551 puts, 3 million. More IWM bearish, more IWM bearish. And then 539 puts, almost 1 million. Okay. And then a bunch of bullish Tesla action and other tickers that we were watching. Okay. Now, on the unusual flow side as well, this is contracts that are unusual because they are short-term expiry and they're relatively far out the money. We saw 575 calls being bought. That was 3.8, so you have 3.7. I believe these might have, yeah, they already closed out. More than likely, they were Monday contracts, right? You can see that short expiry. And then you had March 11. These are also likely closed out already, right? So, and then on here you have QQQ, 500 calls for March 11th, also likely closed out already. So short-term price action, still not bullish. Haven't seen that repeat flow, haven't seen that repeat activity where, I can say, okay, people are building upside positions. I haven't seen that yet. So it is a bit worrying, but ultimately, if you're a long-term investor, you should be preparing some dry powder to buy these dips, okay? So this has been a very key point here, which I spoke about last week's session, right? And if we break below it, right? If we break below this level here, then we are likely going to see SPX, we need to see it obviously reject here first, then it can come down into this area here, okay? What concerns me is that we haven't really seen a pullback of any kind. So a pullback into 58.78, or what is this level on SPY? Let me just do it on SPY so that you guys don't get confused, because I know some of y'all are only SPY analysts, right? So let me do it on SPY. So if you look at it on SPY, 585 basically, right? This area. Actually, it has been retested a couple of times, but we haven't had that wave up yet, like a proper wave up on, you know, a shorter time frame. And so if you're looking at that lower bound levels, then, you know, as SPY could obviously fade this key level of support that's been sitting here where it is, right? And if it does fade it, then it'll come down to 555 first, and then if it breaks 555, then it comes down into 539, 540. So that's your downside pivot. Now, if for some reason this week we have like a ton of bullish data, CPI comes out, whatever, really, really cool, or, you know, the Fed says something ahead of the meeting, etc., which I doubt is going to happen, right? I think the bearishness still continues. CTAs are still heavily selling. You still have negative gamma, negative delta environment for market makers. So that downward pressure still spirals, then, you know, you continue to see price action go down. But the only way this reverses back is if you have a very strong close above 585 and 590. Like, you need a very, very strong close above either of these two levels. Then only can you have a reversal setup to get back into the 610, 605, 600 series. Okay. So that's where I'm at in terms of this specific analysis with SPY. Now, if you look at NASDAQ, and just for the interest of everybody, because I think you guys look at more QQQ than NASDAQ. NASDAQ obviously took a bigger hit, right? Because technology stocks were the ones that got smacked. So if you look at this, it's already at 9%, right? And that makes sense because technology is higher beta. And so the more riskiness adds that dimension of more volatility. And more volatility means that you get a bigger drawdown, right? So when you're looking at this, the key support here is supposed to be between 478 to 480, right? This area here, okay? If we lose this week, then we're likely coming down into 450, okay? So that'll be your kind of temporary bottom. And if you come down below that, then you open up 420 to 430. So you have that on your downside radar for QQQ. The upside pivot on NASDAQ requires a much higher level, if you think about it. Yes, a pullback here would be nice, a bounce here would be nice, but actually to completely reverse this trend, you need to get up above 518, okay? And form support above here, which then doesn't happen so easily because you need, not only do you need a massive pullback, you need a bounce on 518 as well, or a bounce lower at 500 or so. So you need a bounce either here or here, right? And then you can make that upside reversal. So once again, here also, no scenario just yet where we have a massive reversal pattern or anything like that. So far, it's showing clear downside territory. Bears are in control of the market temporarily. Obviously not for long, but remember, all of this will reverse at some point. And then, you know, if you haven't bought the dip yet, then you'll see that play out. And the last thing I want to go through is Bitcoin and Ethereum, which are struggling massively, right? And me and Andrew have been waiting for this Bitcoin pullback into 70,000. You know, I drew this freaking golden arch, which has been really funny. It's playing out the way that I drew it out. It was obviously meant as a joke completely, but now it's, you know, so funny that it is playing out. So when Bitcoin comes back into 70-ish thousand, right? This is the area in which I would like to accumulate some again. I bought the last time that I bought Bitcoin was right here when it was at 50 to 60K. The next time I'm going to buy it is at the previous resistance area, which will now turn into support, right? Which I think also at this point, it'll be very obvious that there'll be a golden pocket, okay? So this area is where I would like to procure some with Ethereum. It looks like it's going to lose this level, or I don't know where it's going to go further down, but this is also a good time to add some Ethereum. It's pulled back to the previous highs. Obviously, it has the capability to bounce off these highs, right where it is currently, right? So that's the two other things I want to talk about. But once again, very negative spiral price action on cryptos, right? And so that just gives you the tone of the market, the risk-taking activity, the risk-taking intentionality is not there. And so when that isn't there, then the market doesn't have that upward spiral mood, which comes later, which then we can get into later. Okay. Now, individual tickers, I'm going to post them in a separate video because it'll be too much. And I think Andrew has quite a fair bit to go through as well. So I'll close out by just talking about US 10-year yield and the dollar index and then leave it at that. Last week, look at the dollar. It fell off a cliff. Massive, massive dollar weakness, which is good for stocks, but in a negative environment for stocks, the dollar being cheaper doesn't help, right? And this was an offshoot of the reaction towards monetary policy, the expectations of a trade war, the expectations of the dollar losing value, right? And you have also the 10-year yield, which now is showing signs of a reversal pattern, right? If you look at that long-term reversal pattern, you have the wave up structure, and now you have that higher low, lower low, lower low, lower high, right? That kind of thing. So this is now setting up potentially for this move down, right? And if 10-year yields go down, then what goes up? Someone tell me. If yields go down, then what happens to bond prices? Anybody? No? No? Right? So when yields go down, bond prices go up. And so if you look at TLT here, right, where it is currently, right, this is setting up for a potential rally, right? So that could be a very simple macro trade, but remember, you cannot make that move till after FOMC. Do not take the bullish trade on bonds until after FOMC, personally, because you want to see what the Fed has to say, and what the Fed says is going to make a big difference. But if you look at this on the weekly chart, it's setting up really nicely for that little move here, and then pull back, and then another bounce to the upside. Okay. So at some point of time, I'll be going long. I mean, I'm already long bonds, but long leaps on bonds once this is confirmed that it's moving into an uptrend. Right now, you don't have confirmation yet, right? Look at this weekly candle. Even though the previous week's candle was pretty bullish, right? This week's candle, not that bullish. So we need to wait for a confirmation, and I don't want to get myself trapped into this trade without having upside confirmation, which means TLT needs to break above $94. Then we can trade this up into 100, right? So we'll see when that happens, and I'll leave it here for now. Now, VIX is the last thing. Sorry, super last thing. It's very interesting because the VIX has been more active in previous sessions with much less bearish perception. Okay. If you look at this whole trade war thing that's going on right now, and you put it in comparison with other economic data, like things that have happened, this is just a sneeze, actually, right? The VIX comes up to 24, 26, very regularly. Like, look at how often this happens, right? It's a pretty regular point for the VIX to come up to. Though I must say that on the open interest changes, I have seen some activity for bid VIX at 40. But once again, it's very one-off. It's sporadic. It's not really something that I'm seeing over and over again where traders are positioning themselves like the last time that we traded it. Remember when this happened, right? I caught a piece of that, right? But I haven't seen that right now. So this could very, very easily kind of pull back and then give a little bit of a reprieve to the indices, and then you see everything come crashing down again. So it's going to be a bit of a messy situation. That's why I say play it pivot by pivot, but I hand it over to Andrew now because I've taken enough of your time. I hope that macro breakdown was helpful for you guys. And yeah, thank you.
There we go. All right. Let me share my screen. Okay, let's get into it. Quite a bit to go over, like T said. We've got CPI this week. We've got PPI this week. We've got FOMC next week. There's a lot of things that you want to be cautious of, especially if you're swing trading. And if you're day trading, you don't care about any of that. You're just looking for opportunities to get entry points in. So, real quick, we're going to recap last week because that's going to kind of set up what we're looking at this week. And then kind of some of the pieces of data that are helping us understand kind of what happened. So, if we go to last week, right? This is all expirations, by the way, right? For all contracts. We could clearly see that dealers were long, right? We knew that dealers were long 590. We knew that dealers were long 600, right? These were the two key levels, right? For me, the most important thing when I look at a week and I look for positioning is where is the dealer the most exposed, right? And then that's where I look for opportunities for entry points. Okay, so we knew last week that 590 and 600 were the key areas. And if you go back to the plan, which is written out right at the end, we spotted $32 million in sold puts at strike 600. This position in relationship with the dealer environment, which dealers were in positive delta exposure at the time, right, is what forced market makers to have to sell shares short, creating a selling frenzy, right? Whatever the news is that you guys want to use as your catalyst, this is essentially what forced the market to the downside, right? Creating that selling frenzy, price targeted downside move. We broke 590, right? And that created more selling pressure. So we go back and we look at the price action, right? And this was the prior week. So this was Wednesday, February 26th. And you can see we never broke over 600. And then this is the start of the week, right? This is Monday, right? We had a push up. We never broke over 600. That selling pressure then kicks in and they hedge their way all the way down into 566, I think it was, right? It was like a $30 move into the downside. Okay. This is important because when we look at last week, we knew that 600, there was massive amount of sold puts there and they had to hedge that risk. And 590, which would have been over here, right? Right. 590, which would have been right here, is where they added more selling pressure. And that's what pushed price into the downside. Okay. And so you always want to know where's the largest amount of exposure because that's going to help you understand kind of, okay, here's where I can feel a little bit more confident in my position, or I need to be cautious because I'm on the wrong side of this trade. So before we get into this week, let's take a look at what the algorithms are showing us, right? So if we look at the short-term algorithm, so this is Friday's flow expiring on the shortest term, which would be Tuesday. We could see that positioning was 572 to 5,700, right? This is SPY sitting right around that kind of 572, 570-ish area. We could see them building short positions into close. And this is SPX, right? And SPX is showing us kind of that 5,700 area, maybe even down to 5,680, right? And so if we just take that as an example, right? You guys all know futures are red right now. So yeah, hopefully everybody knows that futures are red right now. Right? So we can go look at this real quick and we can see that price came down into 5,700, which is the golden pocket, right? That's your low, that's your high, and that's your retrace, right? And that brought you right into 5,700 into 5,690. Does that mean we're not going to go to that tomorrow? No, we could totally like sell off tomorrow and come back down here and maybe liquidity sweep this, right? And then maybe see a move. But regardless, right, we can see that this gap down that is happening overnight and probably has Twitter in a frenzy really just came down into this golden pocket area for a potential bounce. So we'll see what happens, right? So we know that. Then we look at the next set of the algorithms and we say, okay, so this is last week's flow expiring this week. And we can see there's some bullish positions, right? Sitting around this kind of 590 area and 595 area. Okay. And you might ask yourself, why is that important? right? Because then again, when we go back to the chart, when we take a look at where this positions us, we can go back to our SPY chart. It's a lot cleaner. And we can say, okay, so 590 to 595, well, where would that put us? That would put us somewhere in this area, right? Here's 590 and here's 595, right? Kind of around this area, okay? So those algorithms, those bullish positions are sitting somewhere up here, okay? And then we take a look at the last one, which is kind of the longer term, right? And that's the month. And you can see that it's bullish, right? And it's pretty bullish. So we're like, okay, so we expect a short-term move to the downside. Will it bounce? We don't know, but we expect some time a short-term down move. And we still see bullish positioning into the longer term, right? Whether it be the week, whether it be the next 2 weeks, regardless. If we take a look at the NAMO, right? Very difficult to figure this thing out. But we know that it's an indicator, right, of sentiment that we came down into the buy zone and we're kind of bouncing down there. So you can kind of, take a look, every time it comes down here, right, you get a nice little strong move there. This one really sold off in August. Big, strong move there. Came down here, big, strong move there. Came down here, big, strong move there. And you can see we're kind of just sitting down here. So, you want to be careful because, again, you're looking for opportunities to trade. And also, what is the probability of the setup that you're looking at, right? And as we dig through this, right, you'll see the opportunities. So the Nazi is long term. So when you guys are looking at this, you're not looking at it on a short term basis. And you can see that any bounce that happened, the Nazi stayed bearish, which tells you the trend is bearish, right? So until this flips, you really don't really think there's a bottom necessarily in. Then you look at seasonality, right? This chart is going all around Twitter, right? Historically, we do sell off into the back end of February, into early March for quarterly expirations. And then kind of the midpoint of March, right? They said the second week. This is probably more after the FOMC meeting. You see some type of bullish movement from the market. So you should kind of expect maybe a little bit more downside early March, and then possibly you get some type of retracement into the back end of March is kind of what I'm expecting. So we go into fear and greed. Well, the market is very fearful right now, right? Could the market fall further? Yes. But this is also areas where you normally see a bounce in the market. So keep that in mind. We're going to skip all this stuff. You guys can go through it if you want. It's just little things here and there. We're going to get into dealer deltas because this is where things have changed. Okay. If we go back to last week's playbook when we had selling pressure from the 600 level, we can see that dealer deltas were positive. Okay. And what that means is that dealers are selling shares into the falls, or they're selling shares into the bounces, right? They're selling the rallies, or they're flushing shares to hedge positions, right? So you think about it, you've got dealers selling shares because of their risk at 600. You have positive delta exposure for market makers. Therefore, they have to sell shares to hedge. And what level are they selling for? 600. So this is important because this changed, right? Whenever I do the playbook, I'm always looking for what changed in the environment. Well, this changed, right? Hence why it's circled. So if we now look at this week, dealers now have negative deltas. So the negative delta exposure causes them to buy the dips up. Now you think about the price action change that you saw into the back end of this week and how price would fall pretty aggressively on the front end of the day. And on the back end of the day, it would always seem to get bought up, right? If you go back and look at kind of some of these smaller windows and you look at kind of how the day went, price would fall really aggressively and then it would get bought all the way back up and you'd probably end somewhat flat. Price would fall really aggressively and then it would get bought up and you'd end somewhat flat. And then price would fall really aggressively and then it would get bought up into the back end of the day. And then price would fall really aggressively and then it would get bought up into the back end of the day, right? So you can see the change in the environment and why you're kind of just chopping around here on a consistent basis versus you're just flushing down, right? And so this is important because one of the levels is different now, right? So if we take a look at the largest level of exposure, which is what I look for, which is 575 and selling pressure at 600. These are your two key levels. So 575 and 600. But you now know that dealers have to buy shares to hedge, which is why 575 is so important. Because if price starts to hold above 575, dealers, based on their delta exposure, have to buy shares to hedge. Therefore, dealers can get squeezed and create a situation where everybody is bearish, expecting more downside, and the market all of a sudden starts to run on you. So there's key levels that you want to pay attention to within this, and it's really March 21st, which is next week, right? Which is the FOMC expiration. We just talked about normally the market flips in the mid to end point of March, which would fall in line with the FOMC meeting. And as you can see, the customers, the whales, have been getting bullish down here at 570, 575, and 580. And the market makers have already had to hedge all of this risk, right? So I'll show you guys real quick, not this one, this one. If we go and we look at positioning here for March 21st, right, we can see that the customer is very long down here. They're long 580, they're long 575, they're long 570. So those are the three levels that I'm really paying attention to this week. And that means the dealers are short, right? 570, 575, and 580. So if we know that the dealers, based on their delta exposure, have to buy shares to hedge, well, what are they hedging then? Well, they're hedging all of their risk at 570, 575, and 580. So if price is above 575, which is your largest expiration for March 21st, then you could see the market bounce here, okay? So now we take a look at the plan and what we kind of expect today. So as you all know, our goal is to spot the key level and then base our risk off of that for entry. Last week, we spotted a large amount of activity around 600. This activity forced dealers to sell shares short as they had to hedge their risk due to the positive delta exposure that drove price from 597-ish down to 566-ish. That was a $30 move. Now, as we look at this week, we see that IV is showing a potential $15 move, targeting 591 or 560. So there is a large amount of volatility built into the contracts for this week. Keep that in mind. Your contracts might be more expensive than you're used to. A few things have changed this week. One, dealer delta exposure has fallen into the negative, forcing dealers to buy the dip to hedge their risk, as you will see from the dealer exposure levels. Two, the key level of 575 is a buying pressure level versus last week, the key level was a selling pressure level. This makes our evaluation easier. Here's what I'll be looking for. Three buying pressure levels, 570, 575, and 580. I will be looking for market makers to continue to buy the dips, hedging their short positions down here, and creating a squeeze on them into the 321 expiration. Only if price holds above 575, the key level, this squeeze should drive price up into the golden pocket and our weekly move of 591.17. Downside would be if price cannot hold above 575 and loses 570, dealers have no incentive to buy price back up, and selling pressure from 600 can continue to push the price down into the weekly move at 560.67, or worse, as dealers' largest positions are short and they can collect the premium. So what you need to understand from that is if we're looking at SPY here for the week, and we know that dealers are short 575 and 580 and even 570, that if price can somehow find a way to stay up here and we break through this $19 billion dark pool zone, then we're looking for price to squeeze up into this $10 billion dark pool zone and then break there to squeeze up into the weekly move, which would be about this $20 billion pocket, right? These are not exact levels anymore. I've just combined different levels to create zones. Then essentially, if it gets through there, it gets to the golden pocket, which is up here at 600. Now, the downside situation that you have to be cautious of is when you see buying pressure, this means that market makers are short. And if I'm short and price breaks below my level, then I have no incentive to buy it back up. So let's say T scenario, right? The market goes to price in, more bad news and goes for a 10% correction because we always want to look at both sides of the market, right? And understand kind of what could happen. If that is the scenario and price does decide to break the lows here, then there's no incentive for buying because you have selling pressure up here that's still pushing down because these expire on 321 as well. And then you lose 570, which is your last buying pressure level. Now the market maker has no incentive to buy this thing up because they can just collect all of this premium, which expires on 321, and hedge all of this risk. So I'm not saying the market's going to fall. I'm not saying the market's going to bounce. I'm saying you need to understand these areas. You also have this $32 billion dark pool zone, which was built over time way back here, right? And if you break this zone, then there's a good chance, right, that this works its way down, very similar to what T just talked about, which is into that 550 to kind of 540-ish area, right? And like T, who saw some interesting activity from a flow standpoint, we also saw some pretty interesting activity from a flow standpoint, as we saw about $15 million in 542 puts for April 17th. And I can show you exactly what these are so you don't have to guess. You can see them. Well, we don't want calls, we want puts. We can go into 417 and we can see these exact contracts right here. 540, what did I say? 546, 542, 542. We can go in, we can see these exact contracts right here. And so you can see one order came in for 5.3 million. A second order came in for 4.7 million, about 940,000, and then 4.2 million. So again, we want to understand the potential opportunities that we could take if price were to break through this 570 area and break this daily order block right here, right? We can go into daily and we can pull up the order block finder. And we know that this is an order block right here that we bounced at, right? And that's exactly where we bounced. So we know that there's buyers right here. So if price breaks below here, then those buyers essentially left, right? And now price has really no support down here. So the way you want to play this or use this information to your advantage is, if price is rejecting off 580, you could probably short. If price is rejecting off 575, you could probably short. If price is closing below 570, short. And if price is staying down here, right, you can feel a little bit more confident to hold hedges or short. But if price is breaking over these levels and starting to bounce off of them, then you want to be very careful if you're trying to short, because essentially what's happening is the dealers are starting to buy shares to hedge, and you can get caught into a dealer squeeze, which can happen very quickly. So now the challenge is majority, this is probably going to happen in the pre-market because you have CPI on Wednesday and you have PPI on Thursday. So not the best week if you are not familiar with those types of events. I would sit on my hands. I probably wouldn't chase the market. Or if you are going to play it, just understand that it's basically a 50-50 coin flip. and the moves are probably going to happen in the pre-market, and you're going to wake up and be like, "Oh my gosh." And that's probably going to be it, right? So just be aware of that this is not a very easy week to trade. There's a lot of different moving parts right now setting up for CPI and PPI in the midweek and then FOMC next week. And so, real quick, for FOMC, here's the way that you can play FOMC. And I'll remind you guys this next week as well. But there is, where is it? Pin messages. Here we go. You can use the kind of this FOMC plan, which usually plays out pretty well. So if you are planning to play FOMC, highly recommend getting connected to how the FOMC move kind of happens. And this is a good little breakdown that we've used constantly to understand how FOMC. So FOMC next week, again, is a very challenging day to trade. And you want to make sure you understand kind of what you're getting into. So I'll open it up to you guys for just SPY. What questions do you guys have about the plan? And is everybody clear on kind of what to expect this week?
I think it's pretty straightforward, like in terms of what we're expecting. You need a much higher level for bullish reversal. Otherwise, you should be looking for either sideways movement or rejections for the short entry. It's really, really simple. Don't need to overcomplicate it.
Yep.
If you get a big blast to the upside, then yes, the bullish tables will then come in view, the bullish pivot points. But remember that when it does blast to the upside, don't just immediately go bullish, because you need to wait for that buying pressure to kick in. You need to wait for that positioning to adjust, wait for the bounces, wait for the confirmations, then take your upside. Otherwise, you should be still in the view that the market's going to either move sideways or continue chopping or move further downside.
Yep. The range is 588, like 588.70-ish to about 594.80.
Yeah. That sounds about right.
So, and it's about, I think it was like 4 different levels that I combined.
Yeah.
So I just wanted to clean my chart up. I had too many lines on it. So I was like, I need to get rid of all these lines. So I just combined it into this zone that I can use easier. What's the time frame we should watch for SPY this week? I use 4 hour. I think there is a great correlation to the 4 hour and key levels. But 4 hour doesn't work so much for people that want to day trade. So if you're day trading, you're probably gonna have to smooth that down into a smaller time frame.
Yeah, like
The next one I usually go to is the 15 minute.
Yeah,
And
15
then if
minutes.
I'm really looking at a smaller time frame, which is very rare, then it's usually about the 5 minute.
Yeah,
But for
5 minute, I
me,
think.
for the bigger moves, I usually use the 4 hour.
I think in this kind of a market, you want to avoid the 5 minute. So
Yeah.
I'm with Andrew on that. 15 minute would be ideal. And if something breaks out of a pivot, 15 minute candles, if it breaks out, it doesn't mean that the trend is reversed. Wait
Yep.
for the next and the consecutive, at least 3 to 4 15-minute candles, which forms a 1 hour candle, before you even make a move, in my opinion.
Yeah. I have shares in NVIDIA and Tesla, but I don't want to get in the market this week. Yeah, I mean, I wouldn't blame you. Tesla to me is getting into a really good spot. I just wrote this in my new private server. My new private server that I'm building, which is just going to be channels of individual stocks. Which is the fuck your Furu server. Uh, um, Tesla is exactly where I expected it to get, which is into this golden pocket area. And the biggest level is 300. So for Tesla, you have to, it's very similar to what I just talked about from a SPY standpoint. Look at that, 53 million and 150 puts. Gosh. Um, but it's very similar in you have this massive amount of long positions from a market maker standpoint, and they have to hedge that risk. So under 300, there's technically no upside from Tesla. And then you have 265, right? And so That's essentially what you're kind of watching here from a short-term standpoint. Under 265, there's no upside. I would have to see price get over 265. This is exactly what I expected it to do, as you can see when I posted this way back in like mid-February. I didn't expect it to get down this fast,
Yeah.
but hey, things happen. Um, so it can go, it can technically come all the way down to about 222. That would be the low of the golden pocket. And that's a possibility as well. So, could it bounce here? Yes. I don't think this is a horrible place to start to look to, take a little bit of risk on. But from a data standpoint, you need to get over 265, and then 300 either has to expire or it has to break. Right? Once it expires, it falls off, it all falls off. But right now, you still have that selling pressure there. So, but it did hit the monthly move. So these are the monthly moves based on implied volatility. So it did hit the monthly move to the downside. So not surprised by that. That's what contracts are pricing in. So, and NVIDIA is the same exact thing. I mean, NVIDIA has, again, a huge amount of exposure at 120, I believe it is. Yeah, it's 120. And so you're in the same situation. It hit the monthly move. It hit this golden pocket situation. I need to see it get over 120 again because give the exact same situation where market makers are massively short. And so you don't have any upside technically until you get over 120. So those are kind of the main gists here, right? You can see again, and this expires on 321. So you can again see just massive amounts of long positions from a market maker standpoint, and they have to hedge that risk. So under these levels, you're not looking at too much upside. If you can get over those levels, then you can start to see something, much bigger. But we're basically at the end, so we're not going to have time to do individual tickers. I will do individual tickers tomorrow morning. We probably won't do as much time on the market breakdown and just more time on tickers tomorrow. So we'll do that because we are pretty much
Yeah.
at the tail
I
end
think
of
that's
this.
that's a really good way to set it up, I feel, because doing the tickers now and then doing the tickers in the morning is a bit overkill, and then you have a lot of overlap of people asking the same tickers.
Yeah.
I think that's a great idea.
So we will wrap this up. Um, and then for those that are not in my server, if you know somebody in the server, you can get access. If you don't know somebody in the server, find somebody that you know that's in the server. Because that's the only way into the server. And you can have access to the channels that have all this information. So, all right. Um, well, I don't have anything else. So I wish everybody the best of luck this week. And again, be very careful. You have, CPI, you have PPI, most likely Monday and Tuesday, I expect the market to probably chop and not give us much as people anticipate what that information is going to look like in the pre-market.
Yeah.
So, you guys all have a fantastic one, and I'll talk to you all later.
See ya in the morning. Bye, y'all. A recording will be posted in a couple hours. Hope you have a good one.